firstly, thank you for inviting us along, Ollie, and for those who have joined us today. I guess our conversation is all about options, shares, cap tables, that whole complexity that comes with equity management, and just how imperative it is to get it right. I guess most of you, by the looks of it, have been on your journeys for quite some time, so we'll already have some idea of this. But please let me know if I'm trying to teach grandmother to suck eggs, as it were, and if you'd like me to move a little bit faster. But the whole idea is just taking away the whole notion, the cost and complexity that comes with equity management, and putting together options and share schemes, etc., for all your teams. Okay, so if we just get into the flow of it, and as we were saying earlier, please just ask questions as we go through. A very quick background to myself, just to set some context. So my journey was through oil. I started life as a chemist and moved into the commercial world. 20 years with BP, 6 odd years with SR, listing them in London. In between that, off over to Stanford. And the relevance of that is the whole notion of the ownership effect, which I learnt about for the first time back in 2002. But it's something that I think is one of the most powerful tools that every founder should know about and hold on to and understand. But my own journey was about looking to help early stage entrepreneurs, having had no relevant experience in the background. So when I set up Vested, it was more around seeing how entrepreneurs today the challenges that they were having, and it was more of an experiment. But as we went through the journey, it became evident that this is a real and relevant problem, and if we can solve it, it will make a massive difference for everybody. We talked earlier about the importance of the team, the ownership effect. The ownership effect is this notion that if you have a stake in an enterprise, your relationship with it changes. Emotionally, psychologically, what you bring to the table changes. And success absolutely depends on your team. But today's teams are not the same as they used to be. It's not just a bunch of employees. There are contractors, advisors, investors, NEDs, everybody who is important to your team, to the success of your business, is part of your team, and therefore relevant to have skin in the game. They should have skin in the game, and that's usually in the form of an equity reward, options, shares, whatever. The challenge with this is that putting those rewards together, even for one of those sets of people, is complicated and often very costly. Our objective is to take that cost and complexity away from anybody that you're issuing shares to or options, whether it's investors or any of the other cluster of folk that we talked about there. The old way, obviously, is very convoluted with lawyers, accountants, all sorts of compliances with Companies House. Vested just, as I say, take all that noise away, and you can hear a lot more about Vested later on, either through a conversation with one of the team, or if you'd like to even drop me a line directly. So if we start off with the different types of equity related rewards that you will come across, there are those that are related to people putting cash into the business, things like ordinary shares or pref shares, when you have more experienced angels or VCs or private equity coming into the game. And there's those non-cash investments, people who are bringing their endeavor and contribution to your business. So for those, there are tools like growth shares or options, and we'll go into each of these in a little bit of detail, but again, we'll rush through if you guys feel that you already know this stuff. So let's start off with the pref shares, rather. Ordinary shares, I'm assuming everybody is reasonably familiar with. Somebody gives you some money, you issue the shares. There's a lot of paperwork and noise to be done, but Vested can literally help you issue ordinary shares within minutes and do all the compliances at Companies House and manage your cap table. We'll come to that in more detail later. Pref shares, as I mentioned earlier, it's the sort of shares that you'll end up giving to more serious advisors. So certainly once you get past seed, investors, certainly once you get past seed. The pref shares is basically giving the holder of these shares some preference. Those preferences are usually rights above voting. So there will be specific things that the investor, even if they don't have the normal provisions in terms of the number of shares or the proportion of shares that would be required to stop you from doing something, they may reserve the ability in their agreement to hold, let's say it's C-suite salaries or certain levels of investment or partnerships, etc. The other preferential rights that they will have are around capital, and this is often whether it's on liquidation of a company or even in the situation of a sale of the business. They may well take their money out first, the investment that they made, and then go pari passu with the existing shareholders. They may have multiples of their initial investment out first before the rest of the shareholders get to any of the reward. So it's important with prefs to make sure that you look into these in great detail, because some of these rights may seem innocuous, but it's important for you to make sure you understand what you are letting go of and that you're happy to do that. Obviously, the stronger you are as a business and your negotiating position, obviously some of the softer some of these preferential rights may be. Are there any questions generally on prefs? No. Okay, good. Let's move on then. So that non-cash investment. So when we're talking about ordinary shares or preference shares, you are literally giving value to the recipient equivalent to the money that they put in. So if you were to try and do this for somebody who is not putting money in, then they are essentially receiving value on which they would have to be taxed. So if I were to give you a share that's worth £1 today, then assuming you're a 40% taxpayer, you will have to pay 40p tax on receipt of that share. And given that shares can go up and down, you don't want to have to pay out that tax up front. And certainly if you're getting this reward because of your contribution to the business that's not cash related. So let's look at the different types of reward that you can use where that tax liability is not implied to the recipient on the point of receipt. The most common is options. Options are merely the ability to promise shares to somebody at a point in time that they can buy at some future point in time at that price, and often against some deliverables that they'll have to provide. That said, not all options are the same, and actually in the UK we have some great option schemes, the most significant one being EMI, Enterprise Management Incentive, where people, a founder of a business can give their employees a very substantial tax benefit in terms of the share options, but also the business gets to benefit as well. So let's look at that one first, because as I said, not all options are the same. So an EMI option, if we look at that situation where the shares started at £1 when they've been issued to the counterparty, let's say over the next 5 years the shares go up to £10, and the gain is £9. So under the special provisions for EMI, you only get business asset disposal relief tax on that, so it's only 10%. So on that £9 gain, the recipient would pay 90p. So that means that they would walk away with £8.10. The other benefit of EMI is that the company gets to offset the whole of that £9 gain against corporation tax. So it's a win-win for both parties. And it's very much aligned to that whole notion of the ownership effect, whereby Gordon Brown, when he brought this in, understood that benefit, that if people are vested in the success of the business, they're likely to bring that little bit more. And when success in business is just on the margins, that 1 or 2% of magic that people bring that can make the big difference, he realized that actually it's worth the country giving this tax benefit to businesses to provide this incentive. And it is essentially state aid. So that's EMI. The other option, unapproved option, so there's no HMRC approval required ahead of time. These options are very, very different in nature. If you go through that same journey of the issue price and the exercise price being at £1 and the success of the business taking you up to 10, that £9 gain is now subject to income tax at your marginal rate. So if you're at 40 or 45% tax, you could be losing £4.5 on that gain. Okay, so as a recipient of an unapproved option or an ordinary option, you could be walking away with just £4.95. And from a company perspective, there's no offset of that growth against corporation tax. So if you are eligible for EMI, then it is always beneficial to use it. And just a quick summary on who's eligible. So firstly, EMIs are only available to your employees. So if it's not an employee, let's say it's an advisor or a NED, then it's quite different. So you'll need to use a different tool. They have to be, this has to be their primary job. And there's 2 or 3 different sectors, like lawyers, accountants, or trading companies or property companies where you're not eligible for EMI. But again, we'll go through the details if this is of interest to you when you talk through with one of our equity advisors. Is there any questions on options, just generally around the options? No. Okay. The next tool that we'll talk about is the growth share. So a growth share is again, it's not an option, it's a real share. But the provision of a growth share means that when you receive a growth share, there's no tax liability on receipt, unlike if I gave you an ordinary share. And the way this works is as follows. So let's imagine a couple of founders build a business, they get it up to a £2 million valuation. Each share is £1 a share. So at this stage, £1 a share. If they were to issue somebody that share, the person would have to pay tax. So when Jim comes along, they will issue Jim a share with a hurdle, i.e. a growth share. So that hurdle is equivalent to the current share price, let's say £1, and a small premium, which is known as a hope premium, which can be, let's say, 20%. So Jim will get a share with a 20% premium, a hurdle of £1.20. Okay, that means that when Jim receives this share, it is effectively underwater. So he pays no tax on receipt of that share. However, when the share grows in value, let's say that the business goes to £4 million, so £2 a share or so thereabouts, what will happen, Jim will get all the value that he's helped contribute to the business growth. The existing shareholders will not be diluted of their value at the point of issuance of these shares to Jim, but they will share the growth from that point with Jim. And Jim will only have any tax liability when he actually sells the shares, because it's a capital gain. When he received the shares, they had no value, so there was no tax liability on issuance. Until such time as he sells them and he makes a profit, clearly there is no tax, there's no benefit, so there's no tax being owed until he sells it. So when he sells it, he will only have to pay capital gains tax, and at the moment that's 20%. So it's not as good as an EMI, but it's a damn sight better than an unapproved option for Jim. Okay, this process can be repeated again. Let's say Sarah comes along again, a new hurdle is created for the shares that for the growth shares that Sarah will get. She'll get her value growth from that point onwards. but she won't get any of the value that was created by Jim before she came or from the founders before anybody came. Okay, so this is a great tool for people who are not employed by the business and where you don't want to use that higher tax option alternative of ordinary options. The one challenge with growth shares is that they are real shares. So at the point of issuance, they are real shares. So the tool that we've worked on, and again, to make it simple for founders, is conditionality, which we'll come on to in a second. But just to give you the value comparison for a growth share versus the EMI and the unapproved options. So here, that same journey going from £1 to £10, the hurdle price was £1.20. So the gain is now £8.80. So capital gains tax at 20% means £1.76. So the recipient walks away with £7.04. So it's a lot better than an unapproved option. Not as good as EMI, but if you can't get EMI, then this is great. Okay. So Annie.
Hey, Ifty, who would you normally issue the growth shares to within the business?
Quite often it's advisors, NEDs, who are not part of they're not executive directors. We have had people issue conditional growth shares to strategic suppliers. And it's a really powerful thing where you've got a strategic supplier, and if you think about it just in terms of investment and cash, if you need 10 widgets from this supplier, and each of your shares is worth £1, you have to go out and buy £10 with 10 shares. Now, if your supplier actually likes your business, their willingness to give you the widgets for equity might be quite different. Firstly, they're taking a very different risk to somebody who's giving you cash. Yeah, because if I'm giving you a discounted product or a free service, it's very different for me to do that than for me to give you cash. So let's say they give you the 10 widgets now for 5 of your shares. You'd only do this if you could create that arbitrage. Yeah. So if they're willing to do this for 5 shares rather than the 10 shares that you had to sell to get the money to buy the widgets, now you've done 2 things. Firstly, the value of your equity has just been increased. You've got now 2 widgets for each share rather than 1. And the second piece is, now that the supplier holds your paper, they are now vested in your success. It's a really, really powerful. Everybody wants that paper to be worth more when they sell it than it was when they received it. So that's the beauty of having equity in general, but certainly something like growth share, where you can use in many, many different ways. And yeah, it's a very wide spectrum of use cases. But I'll go into one of those in a second. Does that cover what you were wanting, Annie?
Yeah, that's perfect. Thank you so much.
Okay, so as I mentioned earlier, growth shares are real shares, so you need to be able to be very careful of how you issue them.
We do have another question, Ifty, if you might like to take that first. So Paul, you've got a question?
Yeah, thanks. Nasir, what determines the hurdle?
The hurdle is an objective assessment of the current share value. So we do thousands of valuations at Vested. We will do the valuations that are approved by HMRC for businesses for doing EMIs, for instance. But we'll use the principal methodology for doing that valuation for the growth share as well. And we will put forward an objective assessment of the premium for you as well. With growth shares, with anything where HMRC do not give prior approval for, and they don't do it for many things anymore. It's literally down to you being sensible and objective when you set those numbers. So for us, we have built a valuation engine, which is a combination of software and human experienced valuers. So we will put together your valuation report, which unlike unlike an EMI report, which is for approval, it's a valuation report. This is more of a valuation record, such that if there were ever a challenge by HMRC at some point in the future as to how and where that hurdle was set, then you have a clear contemporaneous valuation record, full report as to how we got to that number. And then, yes, there may be conversations on the margin. Oh, well, especially if, let's say, you issue a growth share today at £1 and you sell the business 6 weeks later or 6 months later for £10, then obviously HMRC are going to come asking questions. But often it's over a long time horizon, and so long as you've been objective in your assessment at the time of issuance, then there's limited potential for challenge.
Okay, thank you.
But we do those valuations for people. So conditionality. Just very quickly, if we think about a situation where we've got an advisor here, could be a NED, could be whoever, but just to keep it very simple, Stephanie is going to give him 100,000 shares if he helps her over the next 2 years with that strategic advice. So in this case, either Stephanie has just set up the business or she's going to issue growth shares. In either case, the shares are worth nothing when they have the conversation. Let's say over the 2 years of Simon's support, the shares get to a valuation of £1. And let's say, just for keeping the numbers simple, after 3 years, Simon sells his shares and they sell at £2. Okay, just keeping the numbers very simple. 100,000 shares, 0, 1, 2. Okay, so one way for Stephanie to do this, and this is unbelievably common, is for her to issue the shares to Simon on the understanding that he's going to do this. Now, you can put together various agreements around this, but one of the challenges is that it is complicated to pull shares back once they're issued. But let's say she issues the shares when they shake hands on the deal. Simon sells those shares, that 100,000 shares, for £2 a share. So he gets £200,000, 40k tax at 20% capital gains. He walks away with 160k. But imagine if he leaves after 6 months or after 12 months. As I said, you can put together agreements that you pull those shares back, but it gets complicated. And just getting a lawyer involved on this makes life really complicated. And if value has accrued to those shares, let's say he leaves after a year rather than 2 years, and those shares are now worth 50p. Then on top of the legal complexity, you then have a tax complexity that you really, really want to try and avoid. Okay, so this is not the best idea for Stephanie to do, but it happens way too often. The other extreme is for Stephanie to say, okay, I'll give you them once you've done the 2 years. In this situation, when Simon gets the shares, they're already worth £100,000. So on receipt of those shares, he will have to pay 45% tax, 45,000, because he's a high rate taxpayer. So he's having to put money into the game, and then he's going to sell them a year later where the shares have gone up by another £1. So there's another £100,000, 20k is 20% tax. So he'll walk away with a net 135k. So you can see this is not a great solution for Simon. And certainly if there's the other risk where Stephanie starts moving the goalposts halfway through the journey, Simon would really not want to enjoy this sort of arrangement. But again, this solution is very common as well. What we've done is made this very simple and minimizes the risk for both parties in the equation and maximizes the benefit. So what we've done is created a mechanism whereby the shares are issued at the point of the handshake. So you can build a rapport and engagement very quickly without too much worry as to whether the person's going to deliver, because the shares are essentially held within a legal and digital escrow on the platform until such times as the conditions have been fulfilled, and then the shares come out of the safe essentially when that's done. So the mechanism is here. So you issue the shares at this point. You have a delivery horizon. You assess at the end of that delivery horizon, did Simon do what he said he was going to do? If the answer is yes, very straightforward. You press a couple of buttons and the shares come out of the safe as if Simon had them on day one. So he'll get that full 160 net reward. However, if Simon only does some of the work or none of the work, Stephanie can convert some or all of those shares to deferred shares and then cancel them. So Simon will never walk away with a single share that he didn't truly earn. But to the extent that he did, he will get it at the best economic net back. That's how conditionality works and how we've made it easy as pie through the platform. And one common use case for this is what we call an agile partnership. So if we think about three friends setting up a business together, everybody's going to bring the same to the table. Everybody should have a third of the business. Very straightforward, right? At some point in time, everybody wakes up and realizes that actually people will make a different contribution, and not everybody's going to be running as fast or working as hard or delivering the contribution that they promised. So at some stage, what you'll do is you'll say, all right, let's just get clear on what the deliverables are. And let's issue some more equity, but this is now conditional equity, conditional on delivery. Arthur's going to deliver X, Susan Y, Jazz Z, and actually now we've got a key fourth party into this. Ella's going to deliver A. So we need her to be truly vested in the business. So let's issue some more conditional equity. So everybody's going to get another 30K, and this can be any number. So I'm just doing this to keep the math simple for folk, but we can literally do this for any number in terms of the reward. But here, as you can see, with the original shares issued at 30,000, we've now got 150,000 shares issued, but these are all conditional on delivery of X, Y, Z, and A, okay? And when we talk about X, Y, Z, and A, it's anything that's measurable and tangible and specific. Yeah, it can be like a sales target. It can be an investment. It has to be measurable. It can't just be, Annie's going to be nice and work hard for the next 2 years. Yeah, you have to, just as you would for any cash bonus or cash reward, you have to decide, what is this person going to actually do, right? And you can set this on a 6-month horizon, annual, a 1-year horizon, multi-year horizon. It's very, very straightforward through the platform. But the key is being tangible, measurable, and specific. You can actually break X down into, let's say, X1 plus X2 plus X3, because you can have sub-milestones. It's simply maths, okay? So when you get to that delivery horizon and you test out, what did the folk actually deliver? This is how the agile partnership really comes into its own. You've got Jazz here, Arthur, who delivered 95% of what was asked and expected, holds on to 95% of his conditional shares. He still ends up with a third of the business, which is brilliant. Jazz, however, really didn't deliver on what they were looking to do in terms of delivering Z. A fraction of it, a quarter of it, and so they only hold on to a quarter of their conditional shares. And as a consequence, when you have deferred and then cancelled those other shares, their equity has come down to 15%. So what happens with the shares that get deferred, basically you're concentrating the capital down. And then what you've got is that the shareholders now, the team now have their proportionate amount of the conditional equity. Sorry, of the total equity that's issued. Is that clear? Does everybody understand how conditional equity works in an agile partnership environment? Cool. Obviously, you can use an agile partnership or a conditional growth share structure for literally anything. And I love working with the team when they bring more complex scenarios to the table, because it's really interesting to make sure that people get what they have actually contributed to, rather than what they promised, or being, for want of a better word, cheated out of the reward that they've actually earned. None of those work for me. If you've delivered, you should get, and therefore make it easy for people to work these equations. Okay. So that's the work we're going to do on equity. I can just give you a very highlight view of two of the other products that we've launched at the moment, or brought into being at the moment. One is Vested Light, and this we are offering to all the folk at Startup to Stand Up at a 50% discount. So that means basically, £12.50 for the first year to do all of this, whether it's all, because Vested is an amazing platform insofar as it's got an integrated two-way connection to Companies House. So when you issue shares, you're doing them through the platform, and I can even show you how to do that through the platform if it's of interest. But it takes moments. The platform will go through the authorization for you. The board shareholder resolutions are created and held. The money lands in your bank account. 5 minutes later, you just put in the name, address, emails of the new shareholders as a price paid. The platform will then generate the SHO1 and file it over with Companies House for you, real time. It will generate your new share certificate, send it out to the new shareholder, real time, and it will update your cap table, real time. So it just manages everything to do with the issuance of equity. And this aspect of it, Vested Light, is there at a ridiculously low cost for you guys in particular. So all that COSEC stuff that you have to do, it's all available there, issuing confirmation statements, issuing shares, even converting share classes or creating new share classes. For you also, within the platform, there's a secure data room, so you can keep all the docs that you're building up as you build the business, not just those that you file at Companies House, but also those that you have as you're building the business. This has become the most used part of our platform, because when it comes to the investment round, you simply give the lawyers of the investors the URL plus permission to access the data room, and they can just diligence your business, whether it's an investment or an exit round. It's amazing. And there's also a huge pile of documentation in there for you to have that's free, because the whole essence of Light is to help people get past go, build their businesses at as low a cost as possible, but managing their equity in a way that whatever stage they get to, it's safe. I won't go into the other one in great detail, but launch is basically allowing you to even set up your company, incorporate the business, and set up an agile partnership from day one for those early founder partners. This is useful for zero value companies, so it's not where you already have value. That would be the normal vested platform. But if you're just creating a new partnership now, you can launch it, create those agile partnership structures, and on Vested it's £50 a month, and you only have to stay as long as you feel that you need it. But for Startup to Stand Up, it's at a 50% discount for the first year. So again, £25 a month for as long as you need it, and you can leave at any stage. I mean, one of the things about Vested is that I don't want people to be on the platform if they're not getting value from it. So on the normal Vested platform, there's a minimum of 1 year participation. After that, you can download everything that you've done on Vested and walk away if you are so inclined. We don't have that happen very often. We have we're very proud of the 99% retention that we have, but the key there is, because we're regulated, we cannot entrap people. And so that's on top of that personal philosophy that I have, that I don't want anybody on the platform who's not getting value. On Vested, being regulated, we can't entrap. So you have to be able to move away. So given the work that we do for the main Vested platform uses, there's a minimum of 12 months participation on the platform. For Light and Launch, you can leave after a month, after 2 months, whenever. So there's no minimum period either there, because it's that philosophy of helping you start well. If it's not adding value to you, you let go. I'm going to stop there because I'm just mindful that there's a huge amount of information I've given, and I hope it hasn't drowned you guys. But I'm happy to take any questions.
Ifty, that's fabulous. Thank you very much for that. Quick question from me. The slides you've produced today, can you email them to me, please?
I can. I have to put a huge amount of caution on that in relation to the certainly around the growth share stuff. Being regulated, we have to be very careful of the messages or the understanding of people. Yeah. So I'd be happy to share it with anybody who watches the video as well, so that they understand what I was talking about, especially around the growth shares.
Okay. Any questions from start to stand up?
Just one, if you don't mind, Ifty. Thanks ever so much. That was really good. It's really really valuable for me where I'm right now. I have a partnership with an IT company that are building software alongside us, where part of it is not charged with a view to equity. We haven't firmed up exactly what that's going to be yet. So am I right in what you're saying is that by definition isn't cash, although in a sense it kind of is, so would need to be one of the growth share options potentially?
So if you have if you're agreeing to give them shares, then they can take those shares, but they will have to pay tax on receipt of those shares because you are giving them value. At the point that you give them, let's say you give them a year from now when they've done the job, because hopefully you won't give them the shares before they've helped you on this stuff. If you give them those shares and they are ordinary shares, at that point, whatever value has accrued to the shares at that point, that's the tax point for them. So if it's £1, £10, whatever it is, they'll have to pay tax on receipt of those shares.
Even so, can I just, so for clarity, let's say hypothetically they do £1 worth of work for me. They don't charge me that £1. I give them £1 worth of shares.
And they will see that they will have to take it as income. So effectively, they'll do VAT on that because they're receiving £1. They're essentially giving you a bill.
Yeah. Okay. As opposed to doing it in the growth. Okay, that's valuable. Thank you.
And with the growth shares, as I said, you can agree today that you will get this number of shares if you deliver X, Y, and Z. You deliver that, that's what you get. And I'm giving you them now. So it's not a promise in the future that I'm going to back off on, or I'm Paul, my word is my bond sort of conversation. And then you do what many founders do, which is not quite hold their bond as true. You can actually shake hands on the deal now and issue the shares now. They're held in the safe until they've done the job. And any value that they help you accrue, they're going to get the benefit of.
Super, thank you. Thanks.
Thanks, Paul. Good question. Any other questions whilst we've got Ifty and his team with us this morning?
Yeah, sorry. Thank you very much. Really useful. I'm financially probably not very skilled. I'm sort of about customer experience, product service design, but I've got a couple of opportunities coming up where you work with founders, there's not much money available, and they're saying, well, you could really add some value and help us get customers. So I'm thinking, well, maybe this should be a way that I look at, sort of becoming involved with these companies, and there are but I feel very naive, and one of that companies is actually run by an investment banker, so I'd feel very financially unsure about what I'd be agreeing to. But yeah, I mean, in that kind of service line that they're offering, have you had, is that something that you would feel?
We have a lot of advisors, even mentors, who have suggested to their counterparts that I feel that what I'm bringing to the table is going to change. I'm so confident that I'm going to only take, let's say, 80% of my reward in cash. The rest I'm willing to put at risk with you in equity.
Yeah.
Some people might say, I'm only willing to take 5% risk. Some might say, forget the cash. I'll take 90% of my reward in equity. And because the platform can help you with that, it's a really agile and flexible tool for a lot of advisors, people who want skin in the game. And actually, from a business perspective, you should want these people to have skin in the game. Just having pure transactional relationships with people who are key to the success of your business is normal. Yeah, it's not unnormal, but if you can make sure that they have some skin in the game as well, why wouldn't you?
And would that relationship be? I mean, I'm a limited company, but if you're doing jobbing and you're getting paid, you get paid through the limited company, and then do you get the shares issued to the limited company, or the shares are to your individual?
You can decide.
Okay.
If it's coming to the company, then you'll obviously have to have some structure around how you would account for the work. It may well be just as you do with stuff, discount. But yeah, if VAT is applicable, then yeah, you'd have to plan that into the number that you do the work for. But remember, the reward, the growth share, there's nothing really coming at you. You're essentially doing, let's say you're going to take half and half. Half of the work is at total risk. Could be nothing.
Mm-hmm. Okay. Yeah, lots to think about and learn.
It is, and that's why one of the things for me, I told you about the background. I had the fortune of having very expensive lawyers, merchant bankers helping me do whatever deals I was looking to do, whether it was acquisition of refineries or oil fields or whatever, or even businesses, and helping to set up the reward structures for those folk. But we've been doing vested now for 8 years, and I've learned so much more about how powerful equity can be in aligning interests. If everybody is vested in the outcome of the business, that ownership effect is going to be deployed manyfold. People often think about, oh well, I'm just going to give shares to my leadership team, for instance. Why wouldn't you give it to the whole team? Just imagine if every single person is vested in the success, how that will actually help lift the business.
Okay, brilliant. Thank you.
I've got a question, Ifty. So I'm one of the equity consultants at Vested, and I'll be passing on my details to Ollie following this. If you do want to have a call, by all means, do please reach out, and Ollie will pass on a link to have a call with myself. But I just wanted to ask a couple of questions, because these are the typical questions that people do ask me when I'm on a call. And one of them being, say, for instance, you set up an EMI option scheme for one of your employees. What happens if that employee leaves? What happens to them options then? And I'm sure Ifty can explain.
So EMIs are really powerful tools. As we said earlier, that tax benefit is recognition of the benefit to the company, to the country from successful businesses. EMIs are often deployed into fast-moving tech-type businesses because they only have a validity of 10 years. So from the point of issuance to the exit point, it has to be done within 10 years. And there's a break of about 70-ish% to 30% exit only versus exercisable. Now, the difference here is on an exit only basis, it's basically if you leave before the exit of the business, there's no opportunity. The only point of exercise is when the business has either a monetizing event or an exit. Okay. If it's exercisable, it means any time through that journey horizon, the people can exercise. Once they've earned the rights to those shares, they can exercise them. So exercising means converting the option to a share. So let's say the exercise price was given to you 4 years ago at £1 pence a share or 10 pence a share, and now the business isn't looking at an exit anytime soon, but the founders want you to still remain vested in its success, and so they may have given you exercisable shares. So firstly, exercisable means converting that share from an option, that EMI from an option to a share. They become then shareholders. If it's an exit only, there's a couple of ways that you handle it in terms of if people leave. So if they leave under exercisable and they've earned the shares, they can exercise them before they leave and walk away with them. And you might think, why would I want somebody to walk away with my shares if they're leaving the business? Well, it's two things. Firstly, if they earned them, it was part of their reward, why shouldn't they? But then secondly, you know that if they are holding your equity, even though they've left, they will remain vested in your success. So the notion of giving ideas to competitors, or remaining advocates for your business, it's a really powerful tool. And certainly under EMI, they're usually very small proportions. So it's more about keeping vested than not. If people are leaving, then you'll have good leaver, bad leaver provisions if it's on an exit only, and you can allow people to basically freeze the options at that point in time. And again, the guys will be able to talk you through it, but there's no notion that somebody who leaves, who hasn't contributed to the game, walks away with value, because the provisions are already there for either those shares to be, those options to be pulled back, or conditions around those leaver provisions to be made as straightforward or as complex as you need. Most straightforward would be literally it's board discretion.
Thanks, Ifty. Got a question in from Anna.
Thanks, Ollie. So I'm cautious of time, so I'll make it very quick. Just on a couple of people in our company that are overseas, co-founders, advisors, what types of shares will be suitable for them, as well as is Vested platform able to facilitate the kind of share issue for people overseas? First question. And second question is, for example, with the co-founders, if it is the shares through a vested period and with a cliff period as well, is that something that we can do on the vested platform?
No problem at all in each of those. Firstly, your last point in terms of issuing shares with vesting platform, vesting schedules, easy. That's bread and butter. In terms of people abroad, yes, you can issue shares to them. You can issue options to them. You can't issue EMIs to them. But whatever you do issue to them, so things like growth shares, phantom shares, unapproved options, they will have to be responsible for their tax obligations in their local jurisdictions. So it's always advised that people speak with their tax counsel or their accountants on the receipt of the shares and how they're going to be treated for them.
Thanks, Ifty. I think we've got to wrap things up now, but it's been a very insightful and useful talk for our members, and you're going to get a lot of love and respect on various media channels later today. So it's been very, very useful.